Layoffs are surging. Credit card debt just hit an all-time high. Housing is unaffordable. Small businesses are struggling. GDP is slowing down. And yet, the S&P 500 is near all-time highs. The Nasdaq is ripping. Nvidia is worth more than entire countries. Something doesn't add up. If you don't understand why this is happening, you could make the worst financial decision of your life. Either panic selling at the wrong time, or staying on the sidelines while your purchasing power evaporates. By the end of this video, you'll understand exactly why the stock market can soar while the economy feels like it's collapsing, and more importantly, how to position yourself on the right side of this divide. I'm Jessica, and I'm sharing my research with you so more people understand what is really going on with the markets. Today, I'm going to break down the biggest disconnect between Wall Street and Main Street that we've seen in decades. This isn't about doom and gloom, it's about understanding the game so you can actually play it. Because here's the truth, the people who understand this paradox are getting wealthier. The people who don't, they're getting left behind. And I promise you, by the end of this video, you'll see the financial system completely differently. Let me paint you a picture of what's actually happening in America right now. In 2025, US employers laid off over 1.2 million people. That's a 58% increase from 2024, the highest number since the pandemic. The tech sector alone cut nearly 246,000 jobs, and it's not slowing down. Over 40,000 tech workers were laid off in just the first few weeks of 2026. Credit card debt just hit a record $1.277 trillion. And with credit card interest rates at their highest levels in a century, millions of Americans are drowning. Want to buy a house? Good luck. You now need an annual income of $110,000 just to afford a median-priced home. That's not a mansion, that's a regular house. GDP growth in the fourth quarter of 2025, just 1.4%, down from 4.4% the quarter before. The economy is clearly slowing, and yet the S&P 500 returned over 16% in 2025. It hit an all-time high of 6,932 on Christmas Eve. The Nasdaq was up over 20%, and the Magnificent 7 tech stocks, they returned an average of 27.5%. It feels wrong, doesn't it? Historically, people believed the stock market reflected economic health. When the economy does well, stocks go up. When the economy struggles, stocks go down. Simple. But today, the mirror looks completely distorted. So what's going on? Is the market broken? Are we in a bubble? Is this all going to come crashing down? The answer is more nuanced and more important than any of those simple explanations. And understanding it could be the difference between building wealth and watching your purchasing power disappear. Here's the first thing you need to understand. And this is where most people get it completely wrong. The stock market is not a measure of the economy. Let me say that again because it's that important. The stock market does not measure the economy. The stock market is not a measure of wages. It's not a measure of middle-class health. It's not a measure of small business strength. It's not a measure of how easy it is to buy a house or pay your bills. So what is the stock market? It's a measure of corporate profits. It's a measure of liquidity. How much money is sloshing around the financial system. It's a measure of capital flows, where big money is moving. And it's a measure of monetary conditions, what the Federal Reserve and other central banks are doing. This is the fundamental shift you need to make in your thinking. The stock market doesn't represent the economy as you experience it. It represents capital concentration. It represents the financial health of the largest, most powerful corporations on the planet. What's wild is, those corporations, they're doing just fine. Better than fine, actually. In 2025, the Magnificent Seven, that's Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta, and Tesla, these 7 companies alone accounted for about 32.6% of the entire S&P 500's market cap, 1/3 of the index. 7 companies. When Nvidia goes up 40%, when Alphabet goes up 65%, when these giants are printing money from AI, the index goes up, even if everything else is struggling. So when you see the S&P 500 at all-time highs and wonder, how is this possible when things feel so bad? Now you know. The market isn't measuring your reality, it's measuring theirs. Now, you might be thinking, okay, Jessica, but how did we get to this point? This seems crazy. And you're right to ask, because this didn't happen overnight. This is the result of over 50 years of monetary policy decisions. Let me walk you through the timeline. 1971. President Nixon takes the US off the gold standard. This is huge. Before this, every dollar was backed by actual gold. After this, the dollar is backed by, well, trust, and the government's ability to print more of it. 2008, the financial crisis hits. The Federal Reserve responds with something called quantitative easing, which is a fancy way of saying they created trillions of dollars out of thin air and pumped it into the financial system. They also dropped interest rates to basically zero. The 2000s and 10s. Zero interest rates become the new normal. For an entire decade, money is essentially free to borrow. Corporations load up on cheap debt. Asset prices inflate. 2020, the pandemic hits. And the money printer goes absolutely brrr. The N2 money supply, that's the total amount of money in the US economy, exploded. And by December 2025, it hit an all-time high of $22.4 trillion. That's trillion with a T. Now here's where it gets interesting, and where the central bankers would probably prefer I stop talking. There's this concept called the Cantillon effect. It's named after an 18th century economist, and it explains something crucial about how new money works. When new money enters the system, it doesn't flow evenly to everyone at the same time. It goes first to whoever is closest to the money printer. And who's closest to the money printer? Financial institutions, large corporations, asset markets. By the time that new money trickles down to regular workers and consumers, prices have already risen. The early receivers got to spend the money when it was still worth more. Everyone else gets the inflation. This creates what I call the two economies. There's the asset economy, where stocks, real estate, and financial assets live. This is where the new money goes first. And there's the wage economy, where most people live, where you trade your time for dollars that are worth less every year. The people in the asset economy, they're doing great. Their net worth keeps going up. The people stuck in the wage economy, they're running on a treadmill that keeps speeding up. That's the real split. That's why the stock market can be at all-time highs, while most people feel like they're falling behind. Because they are falling behind relative to asset owners. Now, this video is information dense, and I want to make sure you get it all down. So I made a workbook for you that you can download. It breaks down these key concepts and has reflection questions to help you think through your own situation. Links in the description. Now let me walk you through this two-tiered system even further, because this is where it really clicks. There are 2 types of inflation happening simultaneously, and they affect different people very differently. First, there's consumer inflation. This is what you feel every day. Food prices going up, rent increasing, energy bills climbing, healthcare costs rising. This is the inflation that makes your paycheck feel smaller every month. Then there's asset inflation. This is what happens to stocks, real estate, private equity, and crypto. This is the inflation that makes rich people richer. Here's the key insight. Most people live in consumer inflation. They experience rising costs without rising assets. Wealthy people? They live in asset inflation. Yes, their groceries cost more too, but their stock portfolio went up 16%. Their real estate appreciated. Their net worth grew faster than prices. And here's the part that might make you a little uncomfortable. Central banks, whether they intend to or not, tend to support asset inflation more directly than they fight consumer inflation. When the Fed does quantitative easing, where does that money go? Into financial markets. When they keep rates low, who benefits most? People who own assets and can borrow cheaply. I'm not saying there's some grand conspiracy here. I'm just saying follow the money. Look at who benefits from these policies. It's not complicated. This explains the paradox perfectly. The stock market can soar while living standards feel worse because they're measuring two completely different things. The stock market measures asset inflation. Your grocery bill measures consumer inflation. Both can go up at the same time, and for most people, only one of those helps them. Now here's something that might surprise you. Even professional fund managers, people who manage billions of dollars, will privately admit that markets look expensive. Valuations are stretched, things seem overheated. So why don't they sell? Why don't they go to cash and wait for a crash? Because they're trapped. Rationally trapped. Let me explain. Option 1, go to cash. But cash loses purchasing power every single year. With inflation running hot, your cash is worth less tomorrow than it is today. Sitting in cash isn't safe, it's a guaranteed slow loss. Option 2, buy bonds. But bonds get crushed when inflation is high and interest rates are volatile. Long-term bonds have been a terrible investment for years. Option 3, stay invested in stocks. Yes, they might be overvalued. Yes, there might be a correction. But liquidity keeps flowing. The system rewards asset ownership. And over time, stocks tend to go up, especially when measured in dollars that are worth less every year. So what do the professionals do? They stay invested. Not because they think everything is fine, but because the alternatives are worse. This is crucial to understand. The market staying high isn't necessarily mania or irrational exuberance. It's often a rational response to a system that punishes you for not owning assets. When cash loses value, when bonds don't keep up with inflation, when the Fed keeps pumping liquidity, where else is the money supposed to go? It goes into stocks, into real estate, into anything that might hold its value better than dollars sitting in a bank account. The professionals understand this. That's why they stay invested even when they're nervous. The question is, do you understand it too? But wait, there's another layer to this that most people completely miss. It's not just about monetary policy. Corporations themselves have been engineering their stock prices higher for over a decade. Let me introduce you to the magic of stock buybacks. In 2025, US corporations bought back a record $1.2 trillion of their own stock. That's trillion with a T, the highest amount ever. Here's how it works. A company takes its cash, or even borrows money at low interest rates, and uses it to buy its own shares on the open market. This reduces the number of shares outstanding. Why does this matter? Because when you reduce the number of shares, earnings per share goes up, even if actual earnings stay flat. It's financial engineering. It makes the company look more profitable than it actually is. And guess what? Executive compensation is often tied to earnings per share and stock price. So executives have every incentive to do buybacks instead of, say, investing in workers or R&D. Isn't that convenient? Now here's the really wild part. This buyback bonanza is incredibly concentrated. The top 20 S&P 500 companies accounted for nearly half of all buyback dollars. Apple alone announced $100 billion, Alphabet $70 billion, Nvidia $60 billion. Meanwhile, the number of companies actually doing buybacks hit a 10-year low. So it's not broad-based corporate health. It's a handful of mega corporations using their financial firepower to prop up their own stock prices. This creates artificial demand for stocks, it inflates valuations, and it widens the gap between paper wealth and real economic vitality. The market isn't just high because of AI hype or economic strength. It's high because corporations are literally buying their own stocks with over $1 trillion a year. Markets reward financial engineering as much as they reward actual innovation, maybe more. Quick reminder, if you're finding this valuable, make sure to like and subscribe. It helps more people see this content. And don't forget to grab the free workbook I made for this video. It'll help you apply these concepts to your own portfolio. Okay, let's address the elephant in the room. Or should I say, the 7 elephants. The Magnificent Seven: Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta, Tesla. These companies have valuations that look absolutely insane by historical standards. Nvidia trading at astronomical multiples, the whole group worth more than most countries' entire GDP. So why do they keep going up? Is it just speculation? Is it a bubble waiting to pop? But look, and this is important, it's not just speculation. There are real structural reasons why capital keeps flowing to these companies. First, global revenue streams. These aren't just American companies. They sell to the entire world. When you have 8 billion potential customers, your growth runway is enormous. Second, pricing power. When was the last time you switched away from Google, or stopped using Microsoft Office, or found a real alternative to AWS? These companies have moats so wide you'd need a rocket to cross them. Third, asset-light models. They don't need massive factories or inventory. Their main assets are code and data. This means incredibly high margins. Fourth, AI tailwinds. The artificial intelligence revolution is real, and these companies are positioned to capture most of the value. Nvidia's GPUs power AI. Microsoft and Google are building AI into everything. Meta is spending billions on AI infrastructure. In an inflationary system, where money is being debased and assets are inflating, asset-light, scalable, dominant firms benefit disproportionately. It's not just speculation, it's capital concentration. Money flows to where it's treated best, and right now that's mega-cap tech. Does this mean they can't go down? Of course not. Valuations matter eventually, but understanding why they're high helps you make better decisions than just screaming, "Bubble!" and sitting on the sidelines. All right, let's bring this all together. This is the core thesis. This is what you need to understand. The stock market is high because money is being debased. Let me explain what that means. When governments carry massive debt, and the US has over $36 trillion in national debt, they have 3 options. Option 1, default, just refuse to pay. This would be catastrophic. It would destroy the dollar's status as the world's reserve currency. No government wants this. Option 2, austerity. Cut spending dramatically, raise taxes, pay down the debt the hard way. This is politically impossible. No politician gets elected promising to cut benefits and raise taxes. Option 3, inflate. Let inflation run. Let the debt become worth less in real terms. Pay back today's debt with tomorrow's cheaper dollars. Guess which option they choose? Every single time. They choose inflation. Maybe not hyperinflation, maybe not obvious inflation, but steady, persistent inflation that erodes the value of money over time. And when money is being debased, when dollars are worth less every year, what happens to assets priced in those dollars? They go up, in nominal terms. The stock market isn't broken. It's reacting rationally to monetary policy. It's doing exactly what you'd expect when trillions of dollars are being created and debt needs to be inflated away. When you understand this, the paradox disappears. The market isn't high despite economic problems. The market is high because of the policies designed to paper over those problems. Liquidity remains abundant. The M2 money supply is at $22.4 trillion. Interest rates, while higher than the zero-rate era, are still accommodative by historical standards, and the system continues to reward asset ownership. The market is high because that's how the system is designed to work. So if the system is working as designed, why does it feel like everything is collapsing? Because most people don't own enough assets. Think about it. If you don't own stocks, you don't benefit when the market goes up 16%. If you don't own property, you don't benefit when real estate appreciates. If you don't own a business, you don't benefit from corporate profit growth. What do you experience instead? Consumer inflation, rising rent, higher grocery bills, more expensive healthcare, wages that don't keep up. You experience only the costs of inflation without the benefits of asset inflation. So it feels like collapse, because for you it kind of is. Meanwhile, asset owners, their net worth keeps growing. Their stocks are up, their property values are up. Yes, their groceries cost more too, but it's a rounding error compared to their portfolio gains. This is the wealth transfer dynamic that's been accelerating for decades. And it's not a conspiracy theory, it's just math. The Bureau of Labor Statistics just revised their 2025 employment data. They found that job growth was overstated by nearly 900,000 jobs. The economy was much weaker than we thought while the market was rallying. The stock market was celebrating while Main Street was struggling more than anyone realised. If you're not positioned in the part of the economy that benefits from monetary policy, you're on the wrong side of this divide. And no amount of hard work alone will fix that. You need to understand the game. Now, before you think I'm saying just buy stocks and everything will be fine forever, let me be clear. This system is powerful, but it's also fragile. It depends on several things continuing to work. Stable liquidity, the money keeps flowing, the Fed doesn't dramatically tighten. Manageable interest rates, rates stay low enough that the debt can be serviced, that corporations can keep borrowing for buybacks, that the housing market doesn't completely freeze. Confidence in the currency, people keep accepting dollars, the world keeps using the dollar as the reserve currency. No major policy shocks, no sudden changes that disrupt the system. What could go wrong? A rapid rate spike. If inflation forces the Fed to raise rates dramatically, asset prices could fall hard. A debt crisis. If confidence in government debt wavers, if bond markets revolt, things could get ugly fast. A liquidity crunch. If something breaks in the financial plumbing, like we saw briefly in 2020 and 2023, markets can fall rapidly. Geopolitical escalation, war, trade wars, sanctions. Any of these could disrupt the global financial system. I'm not predicting any of these will happen, but I'm also not pretending the system is invincible. The same leverage and liquidity that pushes markets higher can unwind violently if conditions change. But here's the key insight. Until something breaks, the system keeps inflating. That's been true for decades, and fighting it has been a losing strategy. The smart approach isn't to predict the crash. It's to be positioned to benefit from the inflation while being aware of the risk. So what do you actually do with all this information? Let me give you a framework. Not financial advice, I'm not your financial advisor, but a way to think about positioning yourself in this environment. If asset inflation continues, and the structural forces suggest it will, here's what makes sense. 1. Own productive assets. Stocks, real estate, businesses, things that generate cash flow and appreciate over time. You need to be on the asset side of the divide, not just the wage side. 2. Avoid excess idle cash. Cash feels safe, but it's losing purchasing power every year. Keep enough for emergencies and opportunities, but don't let large amounts sit idle for years. 3. Be cautious with long-duration fixed-rate bonds. When inflation is persistent, bonds that pay a fixed rate for 20 to 30 years can be terrible investments. You're locking in returns that inflation will eat away. 4. Focus on companies with pricing power. In an inflationary environment, companies that can raise prices and have customers who will pay do better than companies that can't. Think about the Magnificent Seven. Think about essential services. Think about dominant market positions. 5. Diversify into real assets, not just stocks. Consider real estate, commodities, even alternative investments. Don't put all your eggs in one basket. The takeaway is this: you cannot fight the liquidity regime. You can only position within it. Complaining about the system won't change it. Understanding it and positioning accordingly, that might actually help you build wealth. The people who understood this 10 years ago are much wealthier today. The people who will understand it going forward will be better positioned for the next 10 years. Let me leave you with this. The market being high does not mean the economy is healthy. It means the monetary system is functioning as designed. The real question isn't, why is the market so high? The real question is, are you positioned in the part of the economy that benefits from monetary policy? If this feels unfair, that's because it is structurally unequal. The system benefits asset owners more than wage earners. It benefits those closest to the money printer more than those furthest away. But ignoring it won't protect you. Understanding it might. This video is information dense, and I want to make sure you get it all down. So I made a workbook for you that you can download. If this video helped you understand the market better, hit that like button. Subscribe if you want more content like this, and drop a comment telling me, are you positioned on the right side of this divide? I'm Jessica, thanks for watching, and I'll see you in the next one.